Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Varsha Jain from Outlook Money and your host for this session. Wishing you a joyful new year. Greetings and welcome to yet another installment in our series where we unravel the intricacies of the financial world, offering insights that may elevate your financial understanding and contribute to your overall financial well being. Today's episode is brought to you in association with ICICI Prudential Asset Management Company Limited, and our topic for discussion is synergy between active and passive investing in building a portfolio. While the market is soaring to lifetime highs, breaking records, it's easy to be attracted and take exposure in equities or stocks. Although market growth and potential are critical factors, one's investment should not be based only on this, but rather on one's own goals, risk appetite, and preferences. Speaking of preferences, mutual funds are comparatively safer than direct stocks for gaining equity exposure in a portfolio. Exploring the intricacies of a portfolio building, active and passive investing, and most importantly, the synergy between them for portfolio construction, we are joined today by Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC. He will be providing valuable insights on this subject for our audience. So, without delay, let's begin the session. Welcome, Mr. Haria, to this episode.
Thank you so much, and wishing all the listeners of Outlook happy, healthy 2024. And again, I congratulate the Outlook Group for conducting these fantastic sessions in association with ICICI Prudential AMC to ensure that investors know exactly where their money is going and the investor awareness increasing is helping the growth in India's financialization. Thank you.
Thank you so much, sir. So now to begin with, please explain how can the combination of both active and passive investing help build a well-rounded investment portfolio? What are the key advantages of incorporating these both approaches?
So, if we look at this debate or this common question that should I invest in active, should I invest in passive? I have always believed that both active and passive investing in India, that is essentially investing in fund manager decided active funds and index following replicating passive funds, is a good strategy because both have a place in an investor's portfolio. The proportions can differ depending on person to person, risk appetite to risk appetite, but generally I feel 75% in active equity and 25% in passive equity is a good combination for your equity exposure. Now, in terms of both, what role do they play? I do believe that both active and passive have the ability, because now in India, unlike earlier, the amount or the diversity of products available in active and passive both have increased, and that helps investors to clearly create a plan, create a portfolio, which you can actually curate. And in that curation of the portfolio, there can be active funds and there will be a list of passive funds which will also fit in well. So I do believe that active and passive both have a role. And as we move along, more on this will get detailed. Thank you.
Yes, sure. So, as a well-rounded portfolio aims to deliver good returns and at the same time offering protection against downside risk, how does the active and passive investing help manage risk in the portfolio?
So, as far as risk management is concerned, when you have passive funds, that too within passive funds, you can decide whether you want large cap, mid cap, small cap, smart beta, sectoral thematic. In active funds, also, you have all of these, and you have a lot more options in terms of choosing different fund managers. The choice is you decide which style works for you, which type of a combination works for you. In terms of risk management, the first level of risk management is always how much of your portfolio allocation you're ready to do in equity and debt. That's essentially called as the asset allocation plan. Once you know, okay, this is the asset allocation plan, this is my goal, this is my objective, this is the kind of time horizon I have to meet my goals, then you can decide on what is the active and passive allocations you want to do. Today, there are many people who think that, okay, my large cap allocations, I want to do it through the passive ETF route. My active allocations, I want to go into flexi cap funds, value funds, special situations funds, and of course, in the active side, the balance advantage fund category and the multi asset fund category, which is essentially the asset allocation category, is also getting very popular. So I do believe that each market cycle has different roles to play in terms of active and passive. But as a general statement, both active and passive should be a part of your portfolio. And within that, if you look at it, there is enough opportunity for you to create a full rounded portfolio using active and passive. What we've seen, of course, is that investors who are looking at plain vanilla flexi cap funds, they basically on the flexi cap side, value side, special situation side, would prefer the active part. While if you look at the selection of smart beta factors like say momentum, low wall, alpha low wall, the passive funds are coming into the fold. Also, as a combination, both active and passive add to diversification as well as the risk management part which you mentioned, wherein on the active side, the fund managers are able to pick and choose the stocks which they want to keep and probably will avoid the stocks which are getting overheated. In the case of passive, that choice is not there, though the selection mechanism will decide which is what is the universe, what is the kind of stocks that come. But a more qualitative judgmental assessment is not possible beyond a point in the case of passive. So, hence, as a risk management tool, having a combination of active and passive works well. And within that, then what products you choose and how you curate the portfolio with the help of an advisor will always decide what is the risk and reward that your overall portfolio has. Because let's say in both active and passive, if you end up having exposure to micro cap, small cap, and mid cap funds, then obviously your returns will look good, but your risk is also high. And if you only have, let's say, large cap funds in active and say the top 50, top 30 names in passive, then obviously your return profile will be low, but your risk profile also will be low in terms of these being the blue chip companies. So a combination of large cap, mid cap, small caps, sectoral, thematic, and smart beta, active and passive, both put together, helps better risk management and also achieve the more important goal of long-term wealth creation while keeping the risks in check. Thank you.
Thanks for answering and clarifying these things. Now, please tell us, should the selection of active, passive, or both the approaches in portfolio construction be linked to an investor's age? How important is this? For example, opting for active investment in youth while risk appetite is comparatively higher, and passive investing through index funds or such in old age. So, how important is age in deciding active or passive or a combination?
Yeah, so in my experience and opinion, I do believe that active investing is popular among the traditional investors who've been investing in mutual funds for long, while the new age investors, the younger investors, who probably are a little bit more influenced also from what's happening in the West, because in West ETFs are getting bigger and bigger, and ETFization is the buzzword. So those youth who are basically looking at the West, they probably are getting attracted towards ETFs a lot more, which is good in India because we have a good combination of, let's say, active and passive offerings which investors can choose from. However, from a fundamental perspective, I don't think any age barrier is there in terms of whether one can invest in active or one can invest only in passive. I do believe at all age groups, whether you are just starting your job. Let's say if you're just starting a job, you'll have high risk taking ability but limited capital. You may want to start with a more aggressive product and that you can choose between active and passive both because both have that option. As you move along, then you'll have asset allocation plans which you'll keep adding. And then by the time you probably are close to retirement, you'll probably reduce the risk level by being more towards asset allocation and less exposure towards the higher risky part of the market. Now, in all of these, both active and passive will play a role. And I do believe that age is not deciding factor
Mhm.
in terms of who should choose active or who should choose passive. I think age only can decide what is your equity risk exposure, what is your timeline, what are the products you want to invest in terms of various products available in active and passive. But all age groups, all investors need to have a combination of active and passive to make it a nice portfolio for long-term wealth creation. Because India, unlike many other countries in the world, has the opportunity or has the potential to deliver both in terms of active and passive a good experience. Thank you.
Okay, as you have said that one can choose 75% in active and 25% in passive investment while creating a portfolio, according to you, what should an investor keep in mind to strike the balance between active and passive investments?
Yeah. So one is, of course, You need to have an advisor to explain to you if you yourself are not conversant within what is active, what is passive, and what are the kind of products. Let's say you understand the markets well, you understand the products well. Then between active and passive, first you'll determine what are the exposure that you want to, let's say. The typical investor wagon wheel, which probably I feel works well, is you have 40 to 50% of your exposure in asset allocation products. By definition, asset allocation products today are available on the active side. So you can choose between a balanced advantage fund, a multi-asset fund, the right proportion. That should be 40 to 50% of your overall exposure. That will give a good foundation on which then you can build a further 25% in flexi cap category on the active side, be it value, be it special situations, be it flexi cap itself, multi cap. You can choose a large and mid cap, whichever category you want to add based on your risk profile. So that's another maybe 20, 25%. So you have 50 plus 25, roughly 75% covered in active equity. In that active equity, of course, if you want to add mid and small cap, you may choose to do so as well, but how much exposure that will be determined by your risk appetite, and your advisor will be able to guide you better. The balance 25%, which we can have in passive. In that, you can of course have a gold exposure, a silver exposure to the gold ETF, silver ETF as well. Sticking purely to equities, there is a world of opportunities in equities available on the ETF side, on the smart beta side. If you want a little bit of momentum in your portfolio, 5 to 10% you can allocate to momentum. Another maybe 5 to 10% in terms of low wall also. You can choose between the various options which are available in passive. Now, think of it that India is going to grow and there are so many companies which are small today which will become bigger. Suppose you want an entry in those companies at an early age, then maybe you can choose the 500 stock universe or 500 stock ETF, where you're getting in the proportion of the weights, but you're getting an early entry into some portion into those lower invested names. So the entire 500 universe ETF would also become an interesting long-term product. Like in the case of West, the S&P 500 ETF is the largest in terms of AUM, running into I think $2 to $3 trillion. So it's the largest. So you can have a situation wherein this 500 stock universe can be good for you as well if you invest systematically in the long run in India. This is the India 500 stock ETF. So on and so forth. You can, so we've seen cycles impact different set of sectors, themes, and to that selection will always be a capability which the advisor will bring in. But in a nutshell, the 50-25-25 rule, which I just explained, can work well for the long term for investors. And there is no specific guideline or scientific way to go
Mhm.
about choosing active and passive percentage. But a certain percentage you stick to, and then you pick the right allocations within that. I think you should be fine as far as your long term wealth creation. The objective can never be that I want the maximum return or I want the lowest risk. The truth will lie somewhere in between, wherein, according to your risk appetite, you would want to generate wealth for yourself and your family. And that appropriate mix will then determine what are the underlying funds between active and passive you choose. Thank you.
Wonderfully explained. Thank you so much for that. And risk appetite is the factor which decides how much you should need to allocate to active or passive. There is no formula as such. And 50, 25, and 25, you explained it. Could you also tell us if somebody wants to do it himself or herself without going to the financial advisor, how can one calculate the risk appetite? Or is it just very subjective?
I think risk appetite is extremely subjective. We've seen, say, for example, two twins born on the same time may have different risk appetites depending on their circumstances. And it's a very subjective thing. So to pinpoint is very difficult. But generally, we've basically seen in India, Indian investors generally, as a rule, have been conservative and less risk taking. With the growth in the economy and the optimism in the markets, and the optimism about India's future being bright as the fifth largest country, going to become the third largest country at some point of time in the future. There
Mhm.
is definitely a risk improvement in the risk-taking ability, which will probably lead to an increase in the risk-taking appetite as well. But yeah, it is very subjective, and hence again, I would request all the listeners to seek advice from professionals who can help you know what your risk appetite, and then accordingly fit a plan for you in terms of what is the right fit of active plus passive, and what are the products that you should have in your portfolio for long-term wealth creation. Thank you.
All right, okay. And according to you, are there specific market conditions where the synergy between active and passive investing is particularly advantageous?
So if we look at market conditions, my experience of the last 18 years and seeing the market cycles, it's essentially, if you look at a market which is in expansionary stage, which is essentially the growth is quite good and well spread, say 2003 to 2008. 2013 to 2017, 2021 to 2024 now, where there is a widespread economic growth. All the sectors are firing at the same time. Generally, it's the active funds which do well, especially on the large cap and flexi cap side. And because in this expansionary phase, a lot of mid and small caps, which are erstwhile were going through a bad time, end up becoming winners. If you have passive exposure in mid and small cap funds at a time where markets are expanding, you have lots of mid and small caps doing well that get well captured by the passive funds in mid and small cap. So in an expansionary phase, what we've seen is that generally the flexi cap and the large cap segment on the active side do well, and mid and small cap segment on the passive side do well. The opposite of this probably happens when there is a recessionary phase or the market falls. During market falls, because fund managers may avoid certain sectors which are overheated, the flexi cap and large cap segment does well. While if you look at the mid and small cap segment, it ends up hurting on the passive side. So mid and small caps, because there's no risk measures which are taken in mid and small cap when the market is in recession. In the passive side, you get the entire 250 stocks or the entire 150 stocks in small cap and mid cap. So just to summarize or recap this question, in an expansionary phase or when the economy is doing well, you'll have active large cap and active flexi cap do well, and generally mid cap and small cap ETFs or passive funds do well, where you get the exposure to the entire universe. While in a recession, generally active large cap and flexi cap funds would do well, while the passive would do probably badly. So that's how it generally works. Thank you.
Okay. Also tell us what should be the investment combination approach in a rising market and
Yeah.
also during a downswing, yes.
In the previous question, just to correct myself, in a downside, the markets in general tend to become narrow. So it's a top heavy large cap names which do well. So active funds in a very big downturn. In the large cap and flexi cap side, active funds in a very big downturn sometimes can feel the pain if they are well diversified, while the mid and small cap segment in the passive side also tends to take a knock when the market is in recession. So you need to do the reverse, but generally to avoid yourself from being in and out, because none of us can keep track and keep changing or maneuvering unless you are basically being advised by an advisor at all points of time and you keep maneuvering. You are better off having a good combination of active and passive across market segments, and then probably select your percentage as well. But yes, there are different market phases in which active and passive work differently, but you really don't need to worry too much about that if you have a well diversified active plus passive bouquet. Thank you.
Okay. And in the long term, which approach is better? Or is it always a combination of both? Also, for someone close to retirement, what would be a preferable approach? And if it is a combination, then what could be the percentage? At 75-25, you have already mentioned, but just for a person who is close to retirement, is it an ideal percentage?
Yeah, so I think even a person who is retiring or a person who is starting new, it's essentially then will boil down to what is the kind of underlying selection of funds that we are doing within active and passive. Because India is a unique country wherein you still have a lot of growth, you still have so many sectors. So both on active and passive, you can have a right selection of portfolio mix, which will ultimately lead to portfolio long-term wealth creation. Now, the percentages can change. For example, in the case of a person who is just about to retire, you may have in the active side only balance advantage fund category or multi-asset fund category or a combination of these, because it reduces your risk meaningfully. Because when you're retiring, capital preservation and wealth creation both become extremely important because you're about to retire. And
Mhm.
on the passive side also, you move towards the, let's say, more stable products like low vol or large cap products, so that your risk taking ability, or rather your risk, is not increased meaningfully. Now, there may be a person who is retiring and is well settled and does not need the money. For that person, ultimately, then the risk taking ability is higher. They can continue to be in the higher riskier sectors or segments also. Again, it depends on each individual person, let's say, at the time of retirement, how they are placed and how much money they need for their own and their family, or versus having something where I'm going to give everything to my family anyways in the later because I don't need the money today. Then they can have a portfolio creation, which ultimately will be determined by the age of their children or the inheritance rather than what they have as a retired. So each person, different risks and different styles and different responsibilities. So I would believe, but though, that 75-25 would work for most, just that the combination or the internal selection of funds can change. Thank you.
All right. And lastly, Could you please share insights into when one should review and rebalance the portfolio to maintain that well diversified and optimized portfolio?
I'm sure there's a lot of scientific work done as to whether you should rebalance your portfolio monthly, quarterly. But I do believe that
Mhm.
looking at your portfolio in terms of rebalancing once in a year, in terms of because what happens typically is that, over a period of 1 year, maybe you got more flows or inflows and more income, and your performance of underlying funds has been different. So your asset allocation can also change a little. So it's good to do it once in a year in terms of a holistic planning. In terms of a quick look, you should definitely have a look once in a quarter with your advisor. But yeah, holistic planning can be once in a year. But it also depends, right? So if an event like the pandemic or the global financial crisis happens, it may make sense at that point of time to have an ad hoc review of your portfolio as well, because those are times where markets become extremely cheap and you end up getting an opportunity to increase your equity allocations meaningfully to take advantage of the subsequent rise which will happen. The only question would be we do not know when the rise will happen. We do not know how much the markets fall before that. But if the markets are very cheap because of an event as big as the COVID or the global financial crisis or the Lehman collapse, it makes sense to basically review it at that point of time also. So don't keep reviewing it every day, of course, but once in a year is good. And when there is a big event, it may make sense to have a look. Thank you so much.
Thank you. So, portfolio construction is a very important exercise, and one should review it time and again. And 1 year is an ideal period, but in case of any unexpected event, one can review and check it if there is anything needs to be changed at that time. Thank you, Mr. Haria, for joining us today and the insights you have shared with us.
Thank you as always. Thank you.
We appreciate your presence, and our listeners are sure to benefit from the details discussed in this episode. It's important to note that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. With this, we come to the end of today's episode of Investment Made Easy podcast. Listeners, we hope you enjoyed our conversation. To dive deeper into investment realms, stay tuned to Outlook Money's podcast series, and don't forget to like, share, and subscribe to stay financially informed. You can also write your suggestions, feedback, and questions at letters@outlookmoney.com. Stay tuned for our next edition. Until then, stay informed and keep following Outlook Money, your favorite personal finance magazine.